Hello everyone and welcome to another edition of Your Daily 5 presented here on Stockcharts TV. I am your host for today's show. My name is Grayson Roze, Vice President of Operations here at Stockcharts.com. So great to be with you for another edition of Your Daily 5. As I always like to say when I have a chance to host this show, one of my personal favorites that we do on the channel with a different perspective every single day. A bit of a quick hit, a shorter format there, but a different perspective from different experts every single day. Always something timely, always something interesting. So it's always fun when I get a chance to host this show myself. So we are going to dive into a couple of the charts that I am keeping a close eye on for the current market. We're going to have some fun today running through some things that I'm watching in this market. So let's get right to it. First up, it always makes sense to start with the bigger picture, start with the broader market. Take a look at kind of where we are at overall. Now, the vehicle that I like to use to do that is VTI. I've talked about this on the show many times. If you follow my work on social media or anywhere else, you know that I'm a big fan of VTI. If you're not familiar with what this is, it is the Vanguard Total Stock Market Index. It is the Vanguard Total Index. Vanguard Total Stock Market represents the entire US stock market in one. Now, this is still a cap-weighted index, so it's going to trade a lot like some of the big cap indexes like the S&P 500, but it does bring in more because, as the name suggests, it is the total U.S. stock market. So a great picture here of what the total U.S. market is doing. And I think it is interesting to note, we've had this mini crash here over the last couple of months. The start to 2022 has been a bit weak, but when we look back and we take a look at some of the support and resistance levels, bring in some basic technical analysis concepts, we can see that we really kind of had prior resistance turned into support, and then we held that support level again. That was kind of the highs that we saw at the start of 2021. We retested those in May and June of 2021 as well. And what we really did was just come all the way back down to test those lows. Or test that support level. We've bounced off that. We've had a nice bounce back to the upside there, and now we're trying to take out some key levels. Again, kind of a similar concept actually. Some prior resistance that did turn into support there at the end of 2021. We broke through those, but we're testing those levels again. Notably, we're doing so above the 200-day moving average, which is the green line there. That 200-day is still rising. It is rolling over a little bit, but this is some price action that I really like to see. We've had a big run here, obviously, over the last couple of years to the upside in the total market. And so to see a bit of weakness, to see the market take a little bit of a breather, but test some levels that actually make sense when we think back over the last couple of years, this is actually quite bullish for me to see us getting back up to these levels. So I do like to see that. What we have up here at the top, by the way, is the Vanguard Total Index versus the Vanguard Total World Index. So this is actually how the U.S. is doing versus the total world. And we can see we're actually pushing back up now towards new relative highs versus the total world. So another little check mark there in the bullish box for VTI. Let's move on. We're going to cheat a little bit here with our next set of charts. I wanted to highlight both of these, but I'm sort of using one of my 5 to actually highlight 2. We're taking a look at something, though, that's very similar. We're looking at the S&P 400 Mid-Cap Index and the S&P 600 Small Cap Index. So not just the total market, not just the big caps with the S&P 500, but if we go a little bit further down the cap tiers, how are things looking? We're doing that with the S&P 400 and 600. Now you can pick your mid-cap and your small-cap vehicles. A lot of people obviously like to use the Russell 2000 for their small-cap vehicle, for their small-cap index. Here, though, if we look at MDY and SLY, again, the S&P 400 and 600, we've seen a lot of rangy trading over the last couple of years. Now, this is interesting because while it's not great, we want to see the market going higher, it's also not terrible. There's a lot of people that have been concerned about this market. A lot of the people have been looking at a chart like VTI that just continues to go higher, or the S&P 500 itself that just continues to go higher. And people have said, this market is so stretched. How can it keep doing this? This is ridiculous. This bull market has run too far, too fast. But again, if we look further down the cap tiers, we can actually see that mid caps and small caps have been doing really nothing but drift sideways for well over a year now. Now, that is not a huge, raging, crazy bull market. That's a lot of indecision on the part of investors, on the part of buyers and sellers out there in the marketplace. So I'm actually right now a little bit reassured by these ranges. These are ranges that we haven't actually lost in the sell-off that we've seen at the start of 2022. We've really just kind of seen a continuation of the patterns that we've been seeing out of the mid caps and small caps for a couple of years now, for well over a year. We've seen both of these groups just continue to drift sideways, and so the fact that we haven't actually lost the bottoms of these ranges in the sell-off that we've seen at the start of the year, that is actually a sign of strength for me. Now, specifically in mid caps, we're actually seeing us push back up to the top of this range. We're seeing small caps kind of sitting still in the middle of that range, but they are pushing above the 200-day moving average, which is great to see. So I'm keeping a close eye on these ranges, as a lot of us have done over the last year or so. Interestingly, we actually were seeing some outperformance from mids and smalls. You can kind of see that there. In February, we saw a lot of outperformance there. We gave some of that back in March, so that has been interesting to watch. But that outperformance out of mids and smalls in February, kind of in the midst of that sell-off, was another little check mark in the bullish box, actually. When we see mids and smalls start to outperform, that is not a bad thing. So the fact that we were seeing that in the midst of a sort of a broader market sell-off was pretty interesting to a lot of technicians, I know. So keeping a close eye on these ranges there in mid caps and small caps. Again, I think it's always important to get out of just the permanent view of the S&P 500. Look a little bit further down the cap tiers. Take a look at what's going on in other corners of the market. Now, our next chart, speaking of other corners of the market, is going to be breadth. Now, we've heard a lot of people talking about breadth thrusts. That might be something that you've heard in the last couple of weeks. We have seen very, very weak breadth recently, but we're starting to see that finally turn around. So what we're looking at here is a multi-chart layout from ACP. This is actually built into the platform. If you go into that layout sidebar on the left side of ACP, you can pull this up as a sample layout called breadth. So I've pulled that up. This is something that I am keeping a close eye on. What this tells us here, we've got the NYSE, we've got the S&P 500, and the Nasdaq from left to right. And the top panels are the percentage of stocks within each of those indexes trading above their 200-day moving average and the percentage trading above their 50-day moving average. We're starting to see these numbers climb back up. The higher these numbers are, the more bullish you can be, basically. And so when we see a lot of stocks in an index trading above key moving averages like the 50 and the 200-day moving average, that is always a good thing. We've seen some seriously weak numbers here, under 50%, which is that red line across all of these, but we're starting to see us retake that key 50% level and move higher. So if breadth continues to increase, if breadth continues to improve, that is another little check mark in the bullish box, especially if we can see price really start to climb back up to new highs in some of these indexes. Now the Nasdaq is still the weakest of the bunch, still pretty far off of its highs, has had just a serious sell-off here in 2022. What's interesting to note, though, about this chart is that we're seeing a lot of NASDAQ stocks recovering their 50-day moving average now. You can see that number, again, back above that 50 level. When we look at the 200-day, we still have a lot of weakness on that breadth metric there for the NASDAQ. A lot of NASDAQ stocks still below their 200-day moving average. But again, that's one that is continuing to climb a little bit higher, and we are seeing a lot of stocks recovering their 50-day moving average in the NASDAQ. So that is a good sign. Next up, we're going to take a quick look at one of my favorite charts to pull up. This is what I call my positioning and exposure chart. So we're looking at a couple of things on this chart. Faded out in the background, we can see the S&P 500. But on the top section, we're looking at the equity-only put-call ratio. So the higher that this ratio is, that means that traders out there in the market are buying more puts. They're a little bit more playing the short side a little bit more in the market. The lower that this ratio is, we can say that traders are a little bit more bullish. They are buying more calls in the markets. So basically, up is bad and down is good, kind of the opposite of a standard chart that you look at. What we can see, though, is that as this ratio has just crashed to the downside, that means that traders are getting long again. A lot of calls coming into the market. So we are seeing traders get a little bit more bullish. Now we can pair that with the panel down below. Oops, I'll go back up there. We can pair that with the panel down below, which is the exposure index among active managers, North American active investment managers. That's what that stands for there. What this tells us is that active managers, active investment managers out there that are doing this for a living have gotten a lot more bullish in the last week. We can see that number skyrocketing. The lower that this number is, it basically means that active investment managers have less exposure to the equity markets. The higher that this number is, that means that active managers have higher exposure to the equity market. So here, high is good and low is bad, basically. When this spikes up like that, we can see that investment managers are stepping in and saying, now is the time to buy. The market feels really good to me. I'm getting long. I'm putting more capital to work out there in the market. And so when this exposure index climbs up like that and we see traders getting more bullish, the combination of those two can be a really nice tailwind for the market. So something that caught my eye, something I am definitely keeping a close eye on. Now, finally, we are going to highlight a chart of Apple. We talked about going further down the cap tier. Now we're going to go back up to the big daddy of them all, Apple, one of the biggest stocks out there in the US market. What I want to point out specifically is that until the last 2 days, Apple was actually up 11 days in a row. I tweeted this the other day. That is a ton of buying, a very, very bullish sign for Apple. But Apple being such a dominant force in the market, when we see that kind of bullish pressure for Apple, that is incredibly bullish pressure for the market overall. Apple, obviously, such a huge weight in so many indexes, such a key part of so many portfolios. So the fact that we saw 11 days in a row of buying, 11 days in a row of Apple closing up, that is just incredible buying pressure to me, something that definitely caught my eye. Now, not only was it 11 days up in a row, we're taking a little bit of a breather there on the last 2 days, but we're also recovering some key levels. Now, this is a new feature of ACP that we actually just rolled out in the platform, a small one, but actually a very helpful feature. This is something that you can turn on in ACP now. It's called the last price reference line. So that dotted line going across the charts, that'll actually show you the last price that whatever security you're looking at has traded at. So in this case, you can see exactly where Apple has been trading. We can see that dashed line is really starting to recover some key price levels. Those are some of the highs that we saw in January and February of 2022. So some resistance there that we're actually starting to take out in Apple. And obviously it's been outperforming the total market. We've got earnings coming up for Apple at the end of April, so still a couple of weeks to go. Another new feature of ACP, by the way, we just added these earnings date chart markers. This is a great example of how they can be useful. You can see those earnings dates right on your charts. So I think a lot of interesting things to note here on Apple, and definitely likely to be a bit of a tailwind for the total market overall when we're seeing Apple so strong as it has been. I mean, look at that bounce off the 200-day and just rocketing higher, recovering the 50-day, trading above some key levels. This is just a beautiful move on Apple. So definitely something I'm watching, not just on its own, but also in the context of the broader market. I think this can be an important tailwind for the market overall. And I want to thank you so much for joining me on today's show. If any of this has rung some bells with you, if you want to keep in touch, you can check out either of my books, Tensile Trading, The 10 Essential Stages of Stock Market Mastery, or Trading for Dummies, both of those available on Amazon or in the Stockcharts store. Check out my personal website, stockmarketmastery.com, or, of course, follow me on Twitter. If you're on Twitter, I'd love to connect. Definitely a fun way to keep in touch there. I'm always sharing charts, always sharing things that I'm watching in the markets, and we have some fun there. Going back and forth on Twitter, sharing charts, sharing a look at what's happening out there in the markets. Finally, I do want to remind everyone, I do my own personal show on Fridays on Stockcharts TV, actually 5 p.m. Eastern now. I've got to change that little label. But Stockcharts in Focus, our product-focused show on the channel where we dig into the site, really kind of dive into features and show you how to get more value out of Stockcharts. The big news this week, we have just released a huge new product release. Tons and tons of new features rolling out on the site this week. So we're going to cover all of that tomorrow on the show, and then a little bit on Saturday as well with our Chart Watchers newsletter. So definitely tune in this week and in the next couple of weeks as we run through everything that's new around Stockcharts. I want to thank you so much for joining me on the show today. I'll be back very soon for another edition of Your Daily 5. But until then, chart on, my friends.
Hey guys, Dave Keller here with Stockcharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.